So tonight we are going to do the same thing that we do on Thursdays, which is we're going to show, in this case, the deal that we have under contract, and we are looking for money to let people from the squadron to participate. We're looking at around 250. We got the plan. We're working on the budget for the renovation. This is a good opportunity. 6 units where we can go and still make some money on the rent, so you can make some money from day one, different than the other one. And nothing. If you have any other deal in some point, last Tuesday, some of the people, they mentioned that they will have they have some deals that they want to share tonight, etc. So we can work on them. But first, we are going to do the one that we have in the bag, and then Luis is going to start talking about his thing tomorrow. And nothing. So basically, again, looking for some money to be part of the group. If you can always either work with Jeffrey or just contact us if there is any other way that you can bring some other people if you want to, or partner with those people. And nothing, we are still looking for more opportunities. There are still in the market, there are opportunities, the kind of opportunities that we like. And what else? Anybody has any specific question, concern, or anything? I know that Moses is busy eating, and thank you for seeing you, Moses, show up. Any concerns? Anything that you want us to cover tonight? Any specifics? No. Okay. People very okay. So people are eager, Luis. People are eager to go and go through the Excel, and hopefully everybody would like to be part of this deal. So I'm going to
the deal, we have the deal. So I'm not going to go over the deal, or I should go over the deal. I was talking to, can you hear me? I was talking to Maria today, and I think the advanced guys we have, Ryan and Maria, they should present this deal. Because in order to get capital, you need to get people going. You need to know the deal. So let's start fast. Remember, we're going to be efficient. Maria and Ryan, can you help each other to explain me the deal? I will explain the right side. Just Ryan, you're going to show this deal to one of your investors. What do you start? What do you say?
First, I show them what the cost of the property is.
You gotta love Ryan. Maria, where do I start always? Or, I mean, you have it. I mean, Maria, what is the first thing Luis style? Because I cannot say it's Luis style, but what will we show? These people that have Sumenesh. Sumenesh is in English too. Share. What about people who will start in? Did I put the wrong share? No, I put the wrong share. What are you seeing? You're seeing the spreadsheet? New share. Share. What is my share? Why is it not working? Hello? What did it do? Okay, now it's working. Share. Share. Somebody said something. Okay. Share again. What is my squadron? Is here. So, Ryan, Maria, Arturo, where do we start? When you see a deal, what is the more important part for us? Cheat here, read. Rent roll, I want the income. If I don't have income, the price is meaningless. I mean, what is the price? Are you an expert in the market? Always will start with the income. I need to know the income of the property. After we go to other things, but they need to know the income. This part, you need to know how to get this. We already talked so many times. Find a good realtor, become a friend of him, so you know how to pay him. Zillow, I don't like it. These other websites, rent.com, many places you can get the rent, but best one, find a realtor that work with you. Find a realtor that work with you. We get the income. This income is already verified. We know the area. That's where we buy it. Second, Maria, what do we do after we know the income?
I would say we figure out our rehab costs. We go and we assess the property to see if how much renovations and estimate that.
That's good. But remember, you're explaining a new person. We have Mr. Charles here. I don't know who you are. Welcome. We have Mr. Charles here that we're going to convince him to buy the building. What Zima? We have one of these. They need to buy the building. So follow this our calculator, guys. Why you want to be creative? Don't be creative yet. Start like Brian said, oh, first thing is here. Let's find out the purchase price. Follow the calculator. Like, I mean, that's what I think. To tell you, the mastermind is so different. If to know something, you do know how to explain something. I'm not saying there's many ways to explain it, but okay, now we can follow the calculator because here is the more important part. Hey, the price, yes, the down payment. This 80-20, to put an 80-20 there, you need to know what type of loan you're going to get. Does anybody know a better loan than 80-20?
There's personal loans. I mean, you can get an FHA loan if you're an individual, but not as a group.
No, as an individual, perfect. So yes, so like this is 80-20 because we're assuming we're buying value add. Yes, we buy value add. We're assuming we need to close in 30 days. So it's very easy. It's one of our strategy. Hey, go 80-20, go with bridge loan, hard money loan. And as far as my concern is today, if not, if there is any lender there that can lend me more, that's the best loan you're going to get. I mean, the best ratio you're going to get today, 80-20. Then follow the line. How much is going to cost me that money? We can get loans at 10.50 today. So you put 10.50. You want this? We never talk about this. Yeah, that's okay. They're good. They're together. Now, we always assume that part, but yes, there is a vacancy rate, which is very low here. You put 3%, 3. I always go too low. This 3 is better. You can never have the building full attendance. You're going to always have a week, 2 weeks break-in. When they move out, they move in. So don't lie to yourself. This full attendance doesn't exist. Now, we come to the operating expenses, which are very important to figure out if that income that you have is enough to do something with the property. Insurance, believe it or not, they're coming down. We got better rates of insurance, much better rate today than we got in December. Maintenance, property management, we always assume a large 10%. Can you do better than that? Yes, you can do better than that. But we always go conservative and we go with high interest, the highest possible on the expense. Water, that building has some units that they share water. So yes, you have to pay some water. Waste and taxes. That's very fair operating expenses. There is much more, but this is the minimum. We're analyzing a property to see if we're going to move in and keep going or not. That now comes what Maria says, the repair, the repair, initial repair. That's very, very important. That's one of your team members that you need to know very well. In the group, we have Jai and other people. Yes, you need to know this guy. For permits, for situation, for many things. That price there is not just a price. That's as important, as the price, the income, and the repair. Acquisition fee. That's a variable that can change depending how you buy it. Reserves. Also depends on the deal. This deal is already rented, so we don't think it's going to never be empty. Closing costs 2% to buy. So we need $314,000 to buy this building. And that's where the magic starts, Mr. Ryan and Maria, because you are already advanced investors. You need to know how to explain this. This is where the magic starts. We don't want, if you are a multifamily first-time buyer, I don't want you to have my sickness that I had 6 years ago, $1.2 million. My payment is about $10,000 per month. Oh my God. It doesn't matter. Why? Because you're not paying for that. The tenants are paying for that. What it matters really is I don't have a $1.2 million debt. I have, this is my investment, 314. That's your concentration. Now, I'm going to share this other screen because you should have that in your mind. And if not, I will prove you how much we need to learn. Cap rate, cash on cash, and debt coverage. That's what you see, no? That's what you see, no?
Yep.
So we have three rates. We have three rates. Arturo, pick one of them on. Explain me cap rate. Or anybody can explain me cap rate. No silence. We're not in a cemetery. We're not in a cemetery. What is cap rate, guys? We cannot do investment if we don't know what is cap rate.
An assessment of the property.
And I love Mr. Ryan. Ryan, you should be Cuban. He always have an answer. Arturo, he totally beat you up. He always have an answer. He's amazing. He doesn't know what he's saying, but he has an answer.
That's how you evaluate whether a property is worth buying or not.
Yes. Totally, it's one of the key factors. But then I'm going to go very beyond because, guys, very beyond. No. We went to a seminar. We spent 3 days with, I don't know how to say his name, Rothcliffe. I paid him, I was supposed to pay $750, but we paid only $250. Thank you to Javier. So always talk to Javier. He gets you very good tickets. So this guy, you can see the guy. This guy had me 3 days there with about 500 people. And I said, great, somebody very smart is going to explain me cap rate. He didn't say shit about cap rate, guys. What we're going to do today, I'm going to teach you cap rates, was Nothing. And we're going to know cap rate today. You might want to have a
I think
pencil.
I know, Luis. Okay, cap rate is how much a property generates in operating income equal to its market value. So if the cap rate is.
That's a beautiful definition. And now you totally lost everybody because now he knows what you're talking about.
Google's my friend, okay? Google is my friend.
Guys, we're talking in English here. We're not talking fancy. She's too fancy. She's a lady. She just gave you the definition. And also Michael told us a very good value. But
If a
cap
property
rate,
is like 14, if a property is worth like $14 million and generating like 600,000 net operating income, it would have a cap rate around like 4.3%.
guys, okay, yes. I mean, but remember, I'm going to ask you to give me $300,000 and buy $1.2 million. If you explain me cap rate like that, we're screwed. You need to sound smart. You need to have glasses like Ryan, voice like Maria, and adventures like Moses. You need to be smart. And smart meaning I know what the heck I'm talking about. So I'm going to go here. I should have a board to draw. Guys, have a pencil and put that because this is, I'm teaching you today, not again. Let me go to share back, share to the, yes, cook. Share. Cap rate formula. Who knows the formula? Guys, I'm going to be upset with you today. I told you so many books to read.
The formula is to divide the property's net operating income by its value.
Correct. That's the formula. You have it now on that page. That's the formula.
Minus expenses, correct?
I mean, I wouldn't. I mean, no. I mean, the expenses are in the NOI. When the NOI is net operating income, so they are already in there. It's revenue minus expenses. So when you put NOI, it's already involved there. So this is, guys. This is when we do the appraisal that we never get to talk about how we do appraisals. And there is appraisal, no, you evaluate the property. And there is two ways to do it. And we have it here. Now we have the income approach and the comparables approach. You want to always use both. But that's why you need the cap rate, because most in your buying strategy and your exit strategy. If we are going, when you say like, by Luis, why you know the building is going to be 2 million, okay? You need to know cap rate. You need to know the effect of cap rate. So the NOI in this property is 129,000. I'm going to round up. So it's 129,000. 129. The value, I wouldn't say I don't want it, but let's say you value it at cost. Let's make a mistake. We value it at cost. That's what we purchase from 1.2 million. Chook. This 1.2 million, yes. I never did this before, so let's see what happens. So now I'm going to divide 129 divided 1.2. We get the cap rate. 10.75%. Now, Ryan, you know what to do. If we get 10.75, what we do? Do we buy it or do we sell?
We buy it.
Buy. 10.75, buy. Okay. 10.75. So, but this is where we're a bit of lying to ourselves because that's a purchase price. Now, how I'm going to sell this? In order for you, I mean, you remember the formula from the school, if you don't math, I kill you. But how do I know the value? I'm going to put easy. I'm going to put value here. We keep the NOI on top. This is math today. And we divide by cap rate. And that will give me the value. That's the math the bank will use to get the value. Today's in the market in Little Havana, Alapata, good areas, the cap rate is 5.70. We know the NOI is the same, 128,000. And that's when the magic comes. You divide NOI by the cap rate of that neighborhood, because that's the key part on cap rates. It's the same cap rate, but it's not the same cap rate. One thing is what you use as a result. Now, if I'm going to evaluate a neighborhood, I need to know the cap rate of that neighborhood that the bank will apply. If not, will not appreciate that. And look what happened. That's the value the building is going to give me, 2.263. Would I find a buyer for that price? No, probably not. That's a very high, that's the top price at the building. But at least I know the bank will lend me to buy it with a DSCR loan. We'll talk in a second, what is that? The price value is 2.2. That's how simple it is to go for the price you buy to the price you can evaluate the property. Through income approach, I can guarantee you, and that we're going to go more deep in the mastermind group, now everybody's by income approach. But if you don't know how to do income approach, when you're already thinking of selling, you cannot say, I'm going to sell this building for 2.5 because there's no bank that will lend this guy 2.5 in Little Havana. So you're dreaming. You're doing your calculation wrong. But that's the income approach, which is the first step the bank will do. Because if you're asking for a loan for 2.5, they will not even ask you for nothing. They say, no, not doable. I will lend you only 2.2 for that building. And then they're going to do comparables. They're not going to, they go at least three ways of looking at the building. Okay, but this is why the cap rate is so important, because we're always thinking about buying, but we need to sell in 1 year. What happened with you guys were a bit new, and so we're staying in the buying right, which is very important. Let's buy right. But now, why we buy right? To sell. This is why you learn the income approach. But the beauty about this is, let's say, and I tell you why in Hialeah we have illegal efficiencies, is because of this. So let's make it legal. Look at what happened here. Okay, that's a regular building. Okay, let's say we are good and we split like we did in one of the buildings. We split a 3-1 into 2-2-1s. That is big enough that you can add a bathroom, another room, split a room. Now you have 2-2-1s. So you have an extra 2-1. And for the sake of value, we're going to say is you're going to get only $1,800 for that, because it's a small 2-1. That's too cheap in Little Havana. $1,800 for a 2-1. Who can tell me what is 18 times 12? Who has a phone? 18 times 12.
216.
216. No, 1,800 times 12 cannot be 216. I expressed myself wrong. Is $1,800, $1,800 times 12.
Well, yeah. So 21,600.
So you see what I'm doing? I'm going to add the 21,000 that Ryan is telling me to that income of the property. Tab. Only increased 40,000. Well, sorry, I was expecting more. So I know because I put 2,000. I put. I know now it's 2,000. Okay, I know it will give me more. 21,000. Tab. Boom. Look at what happened to the building. Now it's not at 2.2. It's at 2.6. That's how a value add is created. It's math, guys. That's when you go from the actual rent to pro forma. Look at here, we went from 12 to 15, 3,000 times 12. We add $36,000 to the building. That's why our buildings go 50% up. That's how you create the value of the building, because the bank or the investor is going to look how much money it's making, what kind of rate I'm getting, and at what price I will buy it.
Is that like Jay can go to a property and look at it and see for himself if that's potential? Like he has to go see it, right? Obviously.
Well, now we're just playing with numbers in the income. So that's perfect mathematically in Excel sheet. You need to go to the property, improve the property, and be able to transfer the rate for 1,450 to 2,000. We cannot go there in a property and just, hey, let's raise the rent. That's what we do. We go, we totally, you know how remodel units, we totally remodel units, even if Little Havana, and that's how these things happen. This is what you need to show your investors, that it's not lack, there is risk, of course, but when you do calculated risk, you don't make mistakes. This is math, and this is how reality happens in life. That's what we do. We increase the value through improvement in the property. We increase the rent, we increase the NOI, decreasing expenses or increasing rents, and you increase the value of the building.
How do you know how big a property, how big a unit is to turn it, like add an extra room to it?
Okay, when you put an offer, you put the LOI, you're going to have 15 due diligence period. Can I say that word? And that's when you can go and see all the rooms. You can go and see, oh, you're asking for more, but you're going to go and see all the rooms. And that's when you calculate your what you can do with the rooms. Till you go and see the property, no. And I will not go by plans, no. Go and see the property because it has to make sense. In the new, so that's one of the best way to increase a property value. Between improvements and buying right, that's why we never have a problem with the business we do, because we do the whole thing correctly. The other way, that when you say RV, after repair value, well, now you need to measure, and there's no way to measure that. That's the gains of the improvements and the market. This is 588 because we're applying at 25%, which is very low, very low. But remember, I'm putting $200,000 of materials and labor. So at least I'm going to add $400,000 of value. When you put $200,000 to a $1.2 million building, you change that building. That's the part that you saw before. Let me have here. Yeah. I mean, let me show you this because I don't know why I'm going this way today, but what I want you is to be able, you ask myself because I saw it. So when I saw it, well, I don't see that shoot here. Okay, let's put this here. Share screen, share. Let me make this big. Let me make this here. This one. Okay, this is how a property looks when we buy it. This is what they look how when we finish. This is when we buy. This is when we finish. You have to have that view too. The view as an investor. You need to know that your property is going to look like this, that you're going to be the best property in the area. Not with marble because you don't want to overprice it, but you're going to be who doesn't want to rent this place compared to this place. Old tiles, probably was old kitchen. We totally remodeled the unit. That's in a la pata. But now we are the best unit. What does to us? We're going to rent it very fast. Sima, you're too quiet today, Sima. So are we clear? Anybody has a question how we add value? Here we're learning, guys. Ask.
Louis, I wanted to ask, you said that you're putting about 195 into this property,
Yes.
material, right? And it's going to increase the value.
Materials and labor. Materials and labor. We don't charge extra for labors.
Increase the value about 400,000. Isn't that what you said?
Yes.
Is it like a rule of thumb that it like whatever you're investing?
No.
About double? No.
There is no rule there. At least I don't know, Javier, you have one with all other years, you have more than me, but no, there is no rule. Okay. This is our experience in the last 3 years in the 12 buildings we have done, plus all remodels we have done. In fact, I tell you, Ryan sometimes can go higher. Okay, than 400, because you're changing the whole spectrum of the windows, the outside. I mean, it's another building. I mean, you
lowering the kitchen and everything.
Yeah, so it's not because you change windows now you invest $10,000 is going to go 15 up. No, it's a new house when you have all new windows, all the roof done, all the tile done. It's new construction to an old house, and that the difference is huge.
Do you know how much it is for marble per square foot?
That's too smart, Moses. That's too smart question. I usually don't do that. Javier, yes, he likes to love that. That will be another way when we go really deep is, yes, always, many times when Jai can explain that more, it's like, yeah, he goes by square feet.
I was just going to say, Moses, that's a question for Jay.
Yeah, when he thinks in repairs and tell me, Louis, let's buy or not, he goes by square feet. He doesn't need to measure the building. It's how many rooms, what square feet on the rooms, what this, blah, blah, blah. He has already numbers, and he can give me an estimate. That the good thing for us also, that it might be not so easy to think to you because you don't think like that, but you should think like that. We don't think of improvements. We're going to take all the floor out and we're going to put a new floor. So we don't have a maybe this cost, maybe, no, square feet, new painting, new baseboards, new floor, new bathrooms. We buy cheap enough that we know that we're buying wrong. Believe it or not, people is not stupid. They never sell us good properties. The properties are beat up. That's why we buy a beat up price. I mean, we're not buying in the court that you can make a surprise, and sometimes when you buy in an auction, you might be very lucky and you get a brand new house with new appliances still there. No, this is an owner that didn't do anything for the last 20 years and 15 years, and that's why he's selling you the house at a 25% discount, 30% discount, because it is run down. any other question on cap rate, because now you learn a much better explanation of cap rate. And let me show you this to see there, if you can read. It says cap rate, class A, buildings, very nice building. You can go down to 3.4. Class B, 4.5. Class C, 5.6. Class D, we don't know. We don't touch Class D. That's demolition. Class C is where we buy, is 5 to 6. That's the cap rate you're using to evaluate properties. Class A is top buildings, of course, and Class C is what we buy. So this is to show you, this is the book. It's not numbers I just create. It's rules that we need to follow, because they already did so many things that they know.
So if it's like class A or class B, you guys wouldn't buy it? Is that what you're saying, or not necessarily?
Not necessarily. It just means that if you're selling to me a building in class A in Coral Gables, the price is going to be too high and the returns are not going to be enough for me. I don't like it. Because we're an investor that we need to buy equity and we want to make money and we want to fix. If you are an investor that's just putting down cash and just want some return and be safe, then you buy class A at 4%. It's good. There's a bit more thinking there, but what you want to get is that the cap rate is in different points of view. It's the same cap rate, but it's one cap rate is to give me an idea to compare apples with apples, to compare if the rate is less than 6%, forget that deal. It's wrong. You don't even go about how much I'm going to spend, because there is not enough income for the value, so it doesn't make sense. So you know that it's under 6%, something's wrong. Or like we were saying, it's such a perfect building, I'm going to spend $0. It's in a perfect area and people want to buy it. So that's why, I mean, you're going to make less money because it's a secure buy, secure sell. And right now with the interest rate so high and insurance so high, it's not easy to buy. That's why we go into C buildings and we make it B buildings. But again, when you need to understand now you're at the bank, the cap rate for the bank is not going to go 10%. It's nothing at 10%. It's like Coral Gable is 4%, Alapata is 6%, 570. Because you want to have an idea of the, this is because today we put kind of like this new concept, but remember, we have an end goal. We want to sell it. So we didn't confuse you guys with all these days because we didn't understand how we're buying. How am I going to tell you what I'm selling? But today we have a lot of smart people in the group, so we move forward to another level. More to tell you guys that this is not lucky guess. And to get this, it's called like people that was in the mastermind and we review the millionaire. Well, it's a motivated decision with knowledge. It's informative decision that we're making. We're not going out there, let's see if we buy. We're not playing roulette. We don't buy by millionaire, let's see what we do. Because rule number one, and we don't have the primas today. Rule number one of investing, Mr. Ryan was told by an old guy.
Don't lose money.
Don't lose your money. Don't lose the principal. And if it's not your money, it's like me that have your money. You don't want me to lose the principal. So so we cannot lose the principal. We need to know what is going to have an idea of what is going to happen. Let me find the other one. If I find it now, what is the other one? New share. New share. What happened to my share? Okay. Now, this is more easy. Second, cash on cash. Mrs. Brandy Luna, you're too quiet there, Brandy Luna. You need to participate. It's not we charge $1 for people that don't say a word.
I'm making
Brandy.
notes. I'm writing notes about everything you're talking about.
That's okay, but we need to laugh, so we need to talk.
Okay.
Can you explain, or do you know? You can say, no, I don't know, Luis. Okay, don't be like Ryan. Don't just tell me something. What is cash on cash?
I don't know.
That's good. Moses, what is cash on cash?
The return.
Moses, I'm an investor. You need to talk to me. If you tell me return, I'm not buying. Do a full sentence. We're not TikTok. What is cash on cash?
Like the return cash off that you put in, the return on that cash.
That's correct. You have the concept. I don't think you are explaining it right.
Well, let me
you
say it
know,
in a more like detailed way.
let me ask something else, because the concept is perfect. You're selling right. Oh, Sima disappeared on me. Arturo, are you there? What is cash on cash, Arturo? A strong answer for an investor that doesn't know you.
Your cash flow divided by all invested cash.
Salim, you're like Ryan. You just gave me an answer there, but it's not enough. I mean, Moses was closer. Remember, guys, you're explaining to somebody that doesn't know, so don't be shy on the words. So everybody really get this in.
Okay, so
Anybody?
I guess get your income and expenses, all income money, and then whatever your expenses is, subtract that, and then times that by 12. And then,
Salim, I give you a vote for you. I give you a vote for all you said, but if I'm an investor and I'm going to lend you $50,000 and you say, I guess, you're out.
The annual cash flow that an investment property generates divided by the total amount of the cash invested in the property.
That's better, Moses. See, that's how you need to speak. If you expect to give you money, because remember, we're going to use OPM. You cannot you cannot go cheap. You need to go, hey, I need to read a book, I need to answer perfect, and I need to give a straightforward answer, like if I know what I'm talking about. I know this because, like Javier, we say it so many times that it's in my mind. But yes, cash on cash. First, look at what it says. It covers investors, so it's very important. It covers investors. They want to know how much money they're going to get on return for the cash that they put in. That's what they want to know. So people that know cash on cash, they know not many. Look, I'm not saying an investor will know how to explain it to you with nice words, but you are asking for money. So you need to have the good words. The guy has the money, so he can talk any language and with any accent, with any whatever he says. You need to get his money. Cash on cash, very, 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 very important. This, I told you, that was my experience. That was my first mistake, that I didn't buy some units because I didn't understand cash on cash. So if we go back to the scenario, we're buying scenario, new share. Where's my building? I should get this short. Second, this here, yellow, move, keep both. Let's go. Are you seeing the whole thing? No, we're seeing only one. Why isn't seeing the whole screen? The software.
So Luis, while
Yes.
you're looking, let me ask. I created an efficiency in my garage, and I paid with permits $35,000, say $36,000 for the purpose of calculation. $36,000 to build out my garage and make it an efficiency. And I charge $1,000 of rent every month. Of the first year, I made $12,000 back. So I got a 30% cash on cash return on my investment.
Yes, which is very good. You should get another garage and do it again.
Okay.
I mean, 30% return is very good. Now you compare one to like the bank that give you 2% of I pay you only 12%, and you're saying you make 30%. That's an amazing return. When you go to equity multiples, in 3 years, you get all the capital back. After that is infinite income.
Yeah, it's straight profit after that.
Exactly.
Money glitch.
But it's not easy to make 30% back. Just Maria, buy a house with 3 garages next time. And we can sell you one. But this is the key that I wanted to show you. When we go here, it says, okay, my cash is 240. My purchase price is 1.2 plus I'm going to spend, here it says the total cost of the building is 155. So why is it so important that you think like an investor and you go cash on cash? Because if you lock your mind in the total cost of the building, 1.5 million, that's a big amount. But in reality, you don't care about the value. I mean, we already bought it, right? I'm not saying you don't care about the value. Right now, I'm talking about I'm going to make money with my money I get back, the cash flow I get, the income I get. So the value reality is not the reality. You need to think how much cash I put in, 314, and how much cash I'm getting out per year. That's the way you want to think. So if let's say, this give you that cap rate, that and in 1 year you can think even cap rate. That's why we tell you anything 6% is not about return on your cash. 8% is good. 10% do it. Above 10%, kill and do it. Remember, you're buying real estate. It goes up in so many other ways and you get so many other value. So if your cash in already gives you a return of 10%, do it without thinking about it. Even if you get 5%, you're getting more than the money in the bank. Did I lose you guys there, or do you understand what I'm saying? Like, I don't want you to focus on the cost of the building. I want to focus, I only need to come up with this money, and I'm going to get a return of 59%. Reality, no, you're going to get a return of 73%. Sorry, I lost you there. But how do I go back? This is when we go to IRR, and that's another complex thing. That's how we look our investments short term. That's how you look your flips when you sell a house. Sometimes you do it just because you do it and you never evaluate the numbers. But this is, believe me, because this is a calculator. I cannot touch it. I cannot change it. I mean, the numbers I input can be wrong, but believe me, they're right. So I'm putting $314,000 and I'm saying I'm getting a return of 73%. As you see here is a formula. I'm not touching the formula. I'm not increasing the numbers. Yes, I need to be correct in the income and the expense, all blah, 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 blah. This is IRR. Now, when I divided that when I divide that by 2 and you get 8%, I don't know what this number is, not this. B154. This calculator is a bit funny today. B1B54. I don't want to confuse you with the 50% LP. Forget this. Go to 70%. You're going to get we're getting on the $300,000, we're getting 70% back. That's why I can pay you 30% because I'm going to make 73%. But think like this. You invest this, you make 73%, do the deal. If you don't do the deal, you're crazy. But that's why I want you guys to understand this calculator and know how it works, the numbers. And I tell you now, I'm thinking funny, where is this number coming from? This number should be half of this. I don't know what they put there. Half. 2 plus. And then you get 8% return. So the investors' return on their money they put on this deal, yeah, is 44%. This
So
is
what
in
about
numbers.
cost? Any cost passed through to us, or the cost accounted for before the?
No, all the cost it has to be planned. I'm losing my mouse. All the cost was here in 195, in the reserves, in the closing cost, in the acquisition fee. All these costs are evaluated here. They're evaluated in this equation. That's why you go to 155. It will be so bad that at the end I had to give you another cost to justify that we make less money. It might happen one day. I don't know. I mean, one of the structures fall down, something not expected, and we might have a very big expense that will affect the business. That's part of the business. But right now, and that's why we never say to you guys, you're going to make 44%. No, we say, hey, you're going to make 30%. If we go up and up, that's great.
I know the dollar amount, depending on the investor, is different, but does the rate of return stay the same whether I invest 10,000 or 100,000?
Now, yes, we are nice people. We don't give you. We're bad people. We don't pay you more if you invest more. In fact, we prefer that you invest in two different apartments. You have 50, put 25, and then you spread out your risk. So, Michael, I mean, I haven't talked to you, but like, we're a small, very strong group that we want to grow, push each other. So right now, there's two ways of thinking, guys. More this is for Ryan and people. Okay, this is for you to buy one, but also for you to get other people, because many of you guys come to me and say, Luis, I don't have the capital. Great. Borrow money from people around you. That's how I grew. I didn't have the capital for the 10 buildings. I asked money. Some of you, most of you that are here, you lend me money already. And that's why you should do. You should learn this, be with us, and borrow money to even invest here. And don't think, okay, but so I tell a friend to invest with me, a friend. No, it has to be an investor person. Yeah, I borrow money from my family, from my friends, for everybody, but I know what I'm doing. Guys, you should, I will not encourage you. You need to know to read my numbers. That's why I always offer that book. You need to understand what the sponsor is telling you, so you know if you're gambling or not. I don't know stocks. You come to me and you explain me stocks, shorts, apps. I don't know how to buy. So if I put money there, I'm going to be gambling. Now, these numbers, I know these numbers. When I go to the street, I put the numbers together in this Excel. I know what I'm doing. And it's math. And the moment you believe that and you see it, we've been seeing it the last 3 years, that always it happens like that, then you understand. And multifamily, that's why I like it much more than houses, because it doesn't go with the economy. Houses go prices up and down with the economy so much. Multifamily, no, is much more stable. And people, when they don't have money and they cannot rent houses, they go to multifamily. We're blue collar, we are average. We're not top, we're not low. So we just want working people that just want to go to sleep to a house and keep on working and improve their lives. That's the type of accommodations we want to invest in. And we invest in, some people like Homestead. I mean, I don't know so much about Homestead. I love Little Havana. I love Alapata. I love that area. If you see Brickell is there, Coral Gable is there. I mean, if you got the right price, you have the rent, the place, like Fontainebleau. I was a realtor so many years in Fontainebleau. There's thousands of apartments there. It's never empty, because it's a great price area, and everybody that needs to go to work downtown, Doral, airport, they need to live in Fontainebleau. If you live in Kendall, the traffic is stupid, and you will lose more money in gas than what you pay in rent in Fontainebleau. So that's the other part, that But again, you need to make informed decisions where you buy, what you do, and then there's no risk. But what we wanted to understand today is that a bit more in deep into the calculator. Anybody that wants the calculator, just WhatsApp me or email me. Michael, I don't know, you're new, Michael. How did you get to the presentation today?
Oh, no, I've actually been around for about 2 years. I've been so busy. I own a commercial lending company. So I'm just starting to get back into what Hob knows me pretty well, but.
Okay. So yeah, I just haven't seen you. So no, because sometimes I don't know who I'm speaking with. I like to give all the information. Sometimes it's too repetitive, but some of the guys here are new and they need to, I mean, for me, it took me a couple of years till they drill the information down and you go through.
Yeah, I've been in the finance game for, I don't know, about 10 years or so. And I live in West Palm Beach, so it's hard to make it down to Miami a lot to the meetings at the squadron.
Okay. So you see, we can pick Michael Mine, we invite him to mastermind and we can, that was the bell? Yeah, I don't know, somebody's ringing in the office. You want to talk? Go here to talk to. I help you to be Armando because when we're at the office at this time, I don't expect nobody to come to buy something, hopefully. But no, it's like, tell you, Mike, we'll invite you. I mean, the next part over there that you can see is like, now, we need to understand DSCR loans because we buy to sell. So we need to understand the buyer we're going to create this property for, that the rents make sense and he can afford it, because if the bank will not give him a loan, guys, we're not going to sell it. Right. It doesn't matter what we put, gold, marble in there. Our investors usually don't have $2 million cash. And when they have $2 million cash, they buy much more than only 2 million. So you're going to sell much more to much more people, sorry to speak like that. It's like, if you have a good income property, that's good to get a loan, easy to get a loan. And then that's simple it is.
Yeah, the DSCR loans are easy to get, but you have to make sure the building you're looking at falls within the DSCR rates within the area that you're trying to buy, because a lender will look at it, and if it's out of whack by more than 5 or 6%, they won't do the deal.
Oh, hold on. You lost many people, even you lost me. But when you say the ratio, you're talking about the 1.1, 1.25, and then the 5%, you lost me there.
Yeah, 1.1, 1.2. When you're looking, when the underwriters go to look at other, let's say you're buying a 10-unit multifamily in Little Havana. Now, if it DSCRs similar to other properties within the area, the deal will go through like that, no problem. They know they're going to get their money back. But if it's on the low end and it doesn't have to be that much further below what the average is in the area, then it's a lot harder to get it done.
I follow you. I understand you.
They do it by comparables, pretty much, right?
No, a bit more, Brian. This year we're going to have Michael in the next mastermind, or maybe next Thursday, and we can go totally on DCR loans. Again, we didn't go into that before because guys, we're still buying. This is more for selling because we do value add. We always buy with a hard money. But yes, you need to understand DCR loans and don't feel lost. I mean, my realtors don't even know what a DCR loan is, and they're 10 years. They've been realtors for 10 years. You have to be in the investment world to understand DCR loans. But what Michael is saying makes totally sense for us, guys. If we're doing a product that it's not going to be able to sell, don't come with the sell and then want to sell. You need to follow the rules of the market. You cannot fight the market. So that's very good information that we probably next Zoom we invite you and we talk more about DCR loan.
Yeah, absolutely.
Then the last way, and that's the one that the cover ratio is exactly that one. On the calculator, guys, you see, many people will like cash flow monthly. All I care that is positive. If this is positive, it's good. Because also remember something that we keep forgetting. We are at 10.5 interest rate because we are under a bridge loan. Today, I'm closing a loan now, Michael, at 7.47. They gave me the lock rate on a DCL loan. No, a DCL loan, no, a bridge, no, a bridge. If I get that on a bridge, I kiss the person. No, it's like on a DCR. So, but look at what happened now. If I decreased my payment, now my cash on cash, that's all going up. A lot. What happened here? I don't know when the calculator lose me. Well, it went down from 8,800 to 6,600. I get 2,020 more per month. On the same property, I didn't touch anything. It's just I'm going to refinance with a DCL loan in a year. I'm going to lower the rate. Bridge loans are always much higher. So when we even do this, even if we buy to hold, we have a big cushion between 10.5, sometimes we bought at 11, 10.5, which is 8,700, going down to 7.47. That's a big cushion. You're talking about $2,000 per month. Now I have a $24,000, $4,000 cash flow. I love it. On a building that is going to pay by itself. So guys, it's 8 something. You wanna close? Any questions?
No, just very well explained. Thank you.
Good. We advanced a lot today, I think, because always we only look numbers. Now we cannot explain today what the numbers are, and we need to keep going like that. So then, in much you see I say people, the numbers talk to you. They talk to you when you know what they're doing. So guys, good night. Keep on looking for this and capital, and we talk soon.
Good night.
Okay, good night.